Good day. In this video, we will take a look at an example of the provisional tax principles discussed in the previous video. The information provided in this scenario is as follows. Tini is 52 years old. She is married to Toby. Both their children are full-time university students. Tini supplies you with the following information of what happened on the dates as indicated. On the 31st of January 2020, she submitted and was assessed for the 2019 year of assessment. Figures from the assessment are as follows. You have taxable income, normal tax, rebates, pay as you earn, current assessment before provisional tax credits, provisional tax credits there, as well as the net payable amount under the assessment. And then on the 31st of August 2020, they have estimated taxable income of 1,100,000, employees tax of 125,782. On the 30th of September 2020, she had actual taxable income for the 2019 year of assessment of 989,552. On the 31st of January, she also submitted and was assessed on the 17th of February 2021 for the 2020 year of assessment. And below are all the figures that were provided or that were included in that assessment. On the 28th of February 2021, she had estimated taxable income of 1,108,368. She had employees tax paid there of 263,659. She had medical fund contributions of 10,889 per month for herself, husband, and 2 children. She made these contributions from the 1st of January 2021. On the 31st of August 2021, she had estimated taxable income of 1,100,752. She had employees tax of 299,562. And then on the 30th of September 2021, she had actual taxable income of 1,056,553, as well as actual employees tax for the 2021 year of assessment of 163,659. We are required to calculate Tini's provisional tax liabilities for the 2021 year of assessment, clearly indicating the relevant dates. Tini does not want to pay any penalties or interest, but wants to pay the least amount of tax payable with each payment. The things that should have stood out whilst reading the information that is provided are as follows. The age of the taxpayer. So this age of the taxpayer should have stood out for multiple reasons if you do not know what is required. But if you know what is required like we do now, the age will be used for the primary rebate when calculating the provisional tax payments. The first provisional tax payment will need to be made on or before the 31st of August 2020. On this date, the estimated taxable income is 1,100,000. Remember, the taxpayer does not want to pay any penalties or interest, but wants to pay the least amount payable. So we will have to look at the basic amount and make a comparison of the favorable amount between the 1,100,000 and the basic amount. The basic amount is the taxable income of the latest preceding year of assessment, as long as it is received at least 14 days before the 31st of August 2020. The latest preceding year of assessment is the 2020 year of assessment, and the assessment for the 2020 year of assessment was received on the 31st of January 2020, which is 214 days. The 14 days rule is therefore met. The basic amount of 1,050,732 will therefore be used as the basis of the first provisional tax payment. The second provisional tax payment needs to be made on the 28th of February 2021. The estimate on this day is 1,108,368, but before it can be used as a basis for the second provisional tax payment, this amount should be compared to the minimum amount, as the taxpayer does not want to incur any penalties. As the taxpayer's actual taxable income for the 2021 year of assessment exceeds 1 million, if we look at the information provided, it is 1,056,553, and therefore the minimum amount is the lesser of the basic amount, or taxable, or 80% of taxable income. The third provisional tax payment, should it be necessary, needs to be paid on or before 30 September 2021. This payment will be based on the actual taxable income if there was a shortfall from the first and second provisional tax payment. In terms of what is required, we are required to calculate TINI's provisional tax liabilities for the 2021 year of assessment and clearly indicating the relevant dates. The first provisional tax payment will need to be paid on or before the 31st of August 2020, and it will be determined using the following steps. So the focus on this slide is the first provisional tax payment calculation. The first step is to determine the estimated taxable income. The estimate will be based on the 2019 year of assessment, which was received not the 2020, but the 2019 year of assessment, which was received on the 31st of January 2020, which is at least 14 days before the 31st of August 2020. That amount, according to the information provided, is the 1,050,732, and it does not need to be adjusted. The second step is to calculate the normal tax on the estimated taxable income. We will make use of the current year tax tables to make this calculation, and this will result in the normal tax amount of 343,571. We need to take into account any applicable rebates. For this first calculation, or for this first provisional tax payment calculation, we will only take into account the primary rebates due to the age of the taxpayer, and also noting that the medical contributions were only made after the 31st of August. We will therefore not consider the medical credits in this calculation, but will consider them in the second provisional tax payment. Because before the 31st of August 2020, the taxpayer had not made any contributions to the medical aid. They only started making contributions on the 31st of January 2021. The third step is to divide our results of 328,613 by 2, because the calculation needs to be paid for the first 6 months of the year of assessment. That will give us a result of 164,307. And in the fourth step, We then deduct any employee's tax and foreign taxes paid during the first 6 months of the year of assessment. Our final result is then the payment that needs to be made of 38,524. In terms of the second provisional tax payment, it will need to be made on or before the 28th of February 2021 and will be determined using steps a bit different from the first calculation as follows. Step 1, to determine the estimated taxable income. The estimated taxable income for the second calculation can be any amount, but in order to avoid any penalties on interest, which is what the taxpayer clearly indicated, the estimated taxable amount or the estimated taxable income should not be less than the minimum amount. According to the information provided, the estimated taxable income on 28 February 2021 is the 1,108,368. We need to compare this amount to the minimum amount as the taxpayer does not want to incur any penalties. As the taxpayer's actual taxable income for the 2021 year of assessment exceeds 1 million, remember it is the 1,056,553, the minimum amount is the lesser of the basic amount, which is 1,050,732. That was from the 2019 year of assessment, or 80% of actual taxable income. And then in this case, the minimum amount is lesser than what is estimated or lesser than the estimated amount. So therefore, we will use our estimate of 1,108,638. The second step is to calculate the normal tax on the estimated taxable income. We will again make use of the current tax tables, and this results in the normal tax amount of 367,313. We need to take into account any applicable rebates. Now, for the second provisional tax payment calculation, we will not only take into account the primary rebates, but the medical tax credits as well, because the taxpayer made contributions to the medical aid fund in January 2021 as well as in February 2021. The primary rebate in this case is the same as in the first provisional tax calculation. That would be the 14,958. And then the 6A medical credits will be made up of the monthly amount of 638 being for the taxpayer and one dependent, as well as 215 rands for each additional dependent. If you look at the information provided, the taxpayer and her husband and 2 children are on the medical aid. The sum of the monthly credits multiplied by 2 months will therefore result in the 2,136. The 6B additional medical expense tax credit is calculated as follows. It is the contributions to the medical aid of 21,778 less 4 times the 6A credits, resulting in 13,234. From that, we less 7.5% of the taxable income of 1,108,638 limited to 0. The third step in our calculation is then to deduct any employee's tax and foreign taxes paid during the year of assessment, and finally to deduct the first provisional tax payment. According to our calculation, that was the 38,524 to get to our final second provisional tax payment that needs to be made of 48,036 rands. Lastly, the third provisional tax payment will need to be paid on or before the 30th of September 2021 and will be determined using the following steps. The first step is to look at the actual taxable income that was given in the scenario, and that is the 1,056,553. The second step is to calculate the tax on the actual income or the actual taxable income, and then we will again make use of the tax tables to calculate the tax. We will then take into account the primary rebates, the medical tax credits. We have used that already in our calculation, so I'm not going to go through that again. And then the third step then is to deduct any employees tax or foreign taxes. That is the 163,659 according to the information provided. And then to deduct the first provisional tax payment, which we determined in the first calculation of 38,524, deducting the second provisional tax payment of 48,036, which we determined in the previous slide. And then finally getting to the final result of 78,645 rands, which is the third provisional tax payment that needs to be made on or before the 30th of September 2021. I hope this example helped in applying the principles of the provisional tax payments. Thank you.